Are you trying to grow your wealth but feeling confused by the terms like index fund, ETFs, and mutual funds? Don't worry, you are not alone. Today, I will break down the key difference between these investment options, their pros and cons, and help you to figure out which one aligns with your financial goals. For those who are new to my channel, welcome. My name is Lincoln. I'm an accountant turned into entrepreneur and author. And over the years, I have the privilege of helping countless people navigating their financial journeys. Trust me, I know how confusing terms like index fund and ETFs can sound. When I first came across them, I felt just as lost as you might feel right now. One of my mentors, a highly respected investment banker, once shared with me, Lincoln, if you want to impress others, make things complicated. But if you want to truly helping others, make things simple. He also told me that if you can't explain a complex ideas in simple terms, you probably don't understand it well enough yourself. So today I'm going to give you a crack. I'm going to break down this complex concept into something easy to understand. I believe investing doesn't have to be complicated. There's no bad students, there's only bad teachers. So stick around, and by the end of this video, you will feel confident and ready to make informed decisions. Let's dive in. Section 1. What do index fund, ETFs, and mutual funds actually mean? Imagine three investors setting out to build their wealth, each deploy a different mindset. The first one says, I will follow a straightforward plan. No complication, no surprise, just steady growth over time. That's your index fund. The concept of index fund was pioneered by a gentleman called John Bogle, the founder of Vanguard. Bogle believed that instead of trying to beat the market, a game most fail over the long term, investors should just aim to match its performance. His philosophy was really simple. Keep costs low, stay diversified, and let the power of compounding work for you. Warren Buffett, one of the most successful investors in the history, has endorsed Bogle's vision time and time again. Buffett said, consistently buying an S&P 500 low-cost index fund, I think is the things that make the most sense practically all of the time. In fact, Buffett has famously instructed his trustee of his estate to invest 90% of his wealth into an S&P 500 index fund for its low cost and steady growth potential. Think of it as planting a well-planned orchard. You pick the best location, plant the seed, and trust the nature's process to grow your trees over time. You don't micromanage every leaf. Instead, you let the season take their course. Similarly, an index fund tracks a broad market index like S&P 500, offering steady growth without the need for consistent interventions. It's a rational approach rooted in a patience and discipline, and its low cost make it a favorite for long-term investors who value simplicity and practicality. Now, the second investor value flexibility and efficiency, saying, I will keep my options open and adapt to opportunities as they arise. That's your ETF, or exchange traded fund. ETFs were first introduced in the early 1990s, with SPY tracking the S&P 500 being one of the first and most well-known. Think of ETFs as the digital revolution of investing. You are no longer bounded by rigorous schedules or limit options. They allow you to trade throughout the day, just like stocks, while still offering the diversification of a fund. It's like driving a hybrid car. Efficient, cost-effective, and adaptable to both cities and highway conditions. ETFs are great for investors who want a balance of flexibility and affordability, while maintaining exposure to diverse assets. Now, the third investor seeks guidance and expertise, saying, I want a professional to guide me and aim for the best result. That's your mutual fund. Born in the early 20th century, mutual funds became widely popular as a way for everyday investors to access the stock market with the help of professional management. Think of it like hiring a seasoned chef to cover a multi-course meal tailored to your taste. The fund manager's job is to actively select investment and adjust the portfolio to achieve specific goals, whether it's growth, income, or capital preservation. But just like fine dining, this expertise comes at a higher price, higher fees, and potential test in efficiency. Mutual funds only trade at the end of the day, meaning you trade convenience for the promise of professional care. While they can deliver impressive results, at times, they are not immune to the risk of market misstep or management error. Now, these are the quick summaries for what we just mentioned. Index funds are straightforward and cost-effective. The steady engine for the investment world designed for mirror the market's performance without excessive complexity or cost. ETFs, exchange-traded funds, combine the simplicity of index fund with the flexibility of stocks, allowing investors to trade them throughout the day while still enjoying diversification. Mutual funds bring professional management into equation, offering the potential for higher returns, but often at the cost of higher fees and less tax efficiency. Next session, we're going to explore the pros and cons of each investment vehicle. Now, let's break it down the pros and cons of index funds, ETFs, and mutual funds using a simple analogy. Think of them as a different modes of transportation. Each has its strengths and weaknesses depending on your destination and how much control you actually want. Index fund is like a train. Index funds are like taking a train. Once you are on the board, it follows a set route and gets you where you are going without much effort. The benefits: firstly, low fees. They are passively managed, so costs are minimal. Second one, reliable performance. Great for long-term investors who just want to match the market's performance. The downside: number one, is less flexible. Like a train, you can't change the course in the middle of the journey. They are not as adaptable as ETFs. Now, ETFs is like a car. ETF like driving your own car. You get freedom and flexibility to start, stop, and change lanes as you wish. The benefits for ETF: number one, they are tradable anytime. You can buy or sell ETFs throughout the trading days, just like stocks. Two, lower costs. Typically have lower expense ratio than mutual funds. Third, tax efficiency. Easy to manage taxes compared to mutual funds. Now the downside about ETFs: over trading risk. The flexibilities can tempt you to trade too often, which can hurt the long-term gains. Secondly, actual cost. Brokerage fees can eat into your returns. Now, mutual funds is like a personal driver. Mutual funds are like hiring a driver. You trust their expertise to handle the journey for you, but it comes with a higher cost. The upside: professional management. Skilled manager aim to outperform the market. Second one, tailored goal. Designed to meet specific objectives like growth or income objective of your portfolio. The downside about mutual funds: number one is higher fees. Management costs can be significant. Number two, performance risk. There's no guarantee the manager's decision will beat the market. Third, tax inefficiency can lead to higher tax compared to ETFs. So each option has its place depending on your investment goals and how hands-on you want to be. Understanding these pros and cons will help you to choose the ones that was the best for your financial journey. Now you come down to the session 3. Which one should you choose? Let's think of this option as different lifestyles. Index fund, great for the minimalists who likes a hands-off, long-term approach. You are happy with steady growth and minimal effort. ETFs, ideal for the adaptable go-getters who value flexibility and wants the freedom to adjust their investment whatever they like. Third, mutual funds. Best for a detail-oriented planner who values professional expertise, doesn't mind paying extra for it, even if it involves some risk. Are you still not quite sure which one fits you? Let's break it down even further. So number one aspect you need to take consideration with is time. How much time do you have? If you want a set it and forget it strategy, go for index fund or ETFs. If you enjoy digging into details, mutual funds might be your thing. Second element you need to consider is budget. Worry about the cost? Then index fund and ETFs are the more affordable options. Third element, risk. If you are aiming for higher returns, are okay with taking some risk, mutual funds could work for you. In my own experience, blending ETFs and index fund is like building a balanced meal, getting all the essential without overcomplicating it. Mutual funds are like a dessert, enjoyable but only if you trust the chef. So how do you choose? It all comes down to your goals, timeline, and risk tolerance. Remember, investing isn't about timing the market, it's about the time you spend in the market. That's one of those phases that's so simple, but it's easily to overlook. It holds the key to how wealth is actually built. Trying to predict every market move or waiting for the perfect moment to invest is like standing at the edge of the river, waiting for the current to stop before you jump in. It's not going to happen. Market goes up and it goes down and then it goes sideways. But over the long term, they reward the patience and punish the restless. The real measure of investing, in my opinion, isn't in finding some secret strategy. It's in understanding how time works. Compound interest doesn't care about your timing. It doesn't care if the market was up, down, or sideways. It cares about one thing only. How long you are willing to let it grow. A little money consistently invested over a long time becomes something extraordinary. Warren Buffett said it the best. The stock market is designed to transfer money from the active to the patient. The less you think with your investment, the more they have a chance to grow. It's not about flashy, it's not about exciting, but it works. Think about investing like planting a tree. You don't plant a seed and dig it up every single week and check if it's growing. You plant it, water it, and trust the time and nature will do the rest. The earlier you plant it, the taller, the stronger it will grow. So stop worrying about timing the market perfectly. The real secret isn't about getting it at the right time. It's about staying in it for a long time. My suggestion would be start early, stay committed, and let time work its quiet magic. Because in the end, wealth isn't built on luck or prediction. It's built on patience and trust in the process. In conclusion, if this video helped you clear things up, don't forget to like and subscribe for more personal finance tips. And tell me in the comment which investment options fit you the best. Thank you for watching. I will see you in the next video. Bye for now.